Okay, welcome everybody to today's webinar where I will be discussing insurance inside a self-managed superannuation fund, and we'll have a bit of a focus on the transfer balance cap and Division 296, because I think insurance certainly takes an interesting or has an interesting place to play in regards to certainly the transfer balance cap, but also once we start to contemplate Division 296. The whole idea of whether or not insurance should be inside or outside of super. And whilst I don't go too deep on, say, the Div 296 calculations, what I want to look at is primarily where some of the key pain points might be, but also where some of the benefits are going to be associated with what people are doing in regards to holding insurance inside their fund. So let's jump straight in and talk through what we need to. Of course, always placing my disclaimer in. A lot of the insurance stuff obviously hasn't really changed a great deal since 2014, and to a lesser extent 2016. But of course, the advent of super reform from 2017 makes us contemplate, particularly from a transfer balance cap, where we need to hold it. And so I want to work through again today, as I said, some of the issues around things such as which interest should we be holding our insurance in. So, if we've got pension and accumulation interests, where should we be holding it? And often get posed the question of, if somebody's getting closer to 65, should they hold insurance inside their fund at all? Should they still have insurance? And I guess the sort of my not my comeback to that, but what I would often question in that regards is, okay, well, particularly if we're looking at people are entering things like home ownership later, so therefore they may be expanding their working years beyond 65 to be able to continue to pay off mortgages and things. And so insurance, I suspect, will certainly have a bigger part to play in regards to people maintaining it longer than perhaps they once did with regards to their funds. So I think there's certainly relevance there. But the other side of things is a lot of the strategy stuff I've been talking about recently with many groups is this whole idea that from the 1st of July, we move into a world where preservation is 60. Therefore, we will see a lot more, and non-assessable, non-exempt income is also 60. So we'll see a lot more people potentially triggering transition to retirement income streams. And whilst they might not be measurable against, say, the transfer balance cap in their early stages, they are if they're reversionary. And so the member passes away and it reverts to the spouse. Well, if that insurance policy is held inside that transition to retirement income stream, there's certainly things to contemplate in that regard from transfer balance cap point of view, but also potentially things like Div 296. So there's a fair bit to sort of play out in that place. So I'll run through, the pros and cons. So, and again, that's really just the theme as opposed to a specific dot point scenario there, the pros and cons of insurance in super, the taxation elements of what occurs when you've got insurance inside of super. And also just from a tax point of view, I'll look at the untaxed element calculation, but also one of my favorites for those that have attended any presentations that I've delivered over the last probably 15 years in regards to insurance is I always reference the future liability to pay benefit deduction. And again, I've had sort of cause to use that recently with clients, and I think it's again something that just needs to be refreshed so that it's always top of mind when we have clients where an event occurs prior to them turning 65. So look, let's have a look at the key things, and we'll sort of work through at a relatively rapid pace these first few bits, just to get into the nitty gritty and be able to spend more time on some of those key calculation issues and key transfer balance caps and Div 296 stuff that we want to. So what we know is that our regulations, our assess regulations, require us to consider insurance for one or more members of the fund. So ultimately, it's something that we need to document inside primarily the investment strategy of the fund, but contemplating whether or not the insurance should be held. So this has been a requirement since 2012 that we've needed to deal with. And of course, if we're then going to consider insurance, we need to know what insurance we're considering. And from 1 July 2014, the only insurance that we can have inside our superannuation fund is insurance that is linked to a condition of release. So if we've got insurance that's linked to conditions of release, such as death benefit, a terminal medical condition, so a terminal illness payment, permanent incapacity, or disability superannuation, as it is in the Tax Act, and income protection, so temporary incapacity, then we can hold those insurance policies inside the super fund, and we can get our deductibility for it. I've already had a question jump up, so let me just look straight at that. In relation to life insurance deductibility, if payment made covers 2 financial years, can the super fund claim full amount in 1 financial year instead of splitting into the 2 financial years? If so, can I please have the supporting regs? Well, I'm not sure that you'll find any supporting regs on that, because what you'll find one pretty simple set of standard rules, which is basically that deductions are claimable when they're paid. So if you have a fund expense, then you can claim it in the year that it's paid. Um, because we work on a cash basis in the superannuation environment. So if you are making that payment in 1 year and claiming the tax deduction for it, then that would sort of flow with any other sort of expense approach to self-managed superannuation fund. But as far as being able to identify any specific regulation for you, I'm unable to do that, because that's just how the tax legislation tends to work. But again, if it's something that we wish to take offline, I'm happy to look further into that. So yeah, so there are 4 types of insurance policies that we can hold inside of super. Um, does this include income protection insurance? Look, again, I guess it comes down to if you're making a premium payment, and I'm going to talk about premiums as we go through here. But if we're talking about the payment of premiums on behalf of an insurance policy held under super in accordance with the regs, which is those 4 policies that I've just highlighted, and the fund has made the payment and claimed the tax deduction, then yes, you can claim it in the year that you pay it. And then, of course, what happens is if you have an insurance policy that is paid out and there is a refund, then there is a clawback for the deduction claim. So the ATO effectively almost unwind that with regards to any refund of the premium. So we do have our grandfathered agreements or grandfathered arrangements in place with regards to any policies that were in place prior to the 1st of July 2014. So prior to that, you could do things like self-insurance. You could have own occupation. You could hold trauma insurance and super, and you can continue to hold those if you had them in place at that point in time. Certainly, trauma insurance is not deductible. Own occupation is proportionally deductible when you've got the rule in there, TR 2012-6, and also the income tax regulations specify the level of deductibility associated with that. And of course, one strategy that was slightly popular sort of back in the day, and I certainly remember presenting on it a number of times, with the idea of utilising cross insurance. But the tax office sort of came down fairly hard on that, sort of around that 2014 or between 2014 and 2016, to say it was no longer possible. So just to reference those any and own occupation deductible portions of the premiums, they're the numbers straight out of the regs, which are also replicated in the ruling that I just referenced. So that's the rule, sort of, as I said, the quick intro of what we can and can't hold inside a superannuation fund: death, terminal illness, which is normally linked with a death policy anyhow, permanent incapacity / disability super benefit, and income protection policies inside super. So what we then want to sort of, I guess, dig deeper into is the taxation treatment of those insurance proceeds, and where and how to hold insurance policies inside the superannuation fund, and then the impact that it's going to have on such things such as transfer balance cap and that. So let's start to work through those sort of key elements and spend certainly far more time on that rather than the legislative references with reference to definitions, etc., etc. So what we know is that when we have a superannuation death benefit, and I'll touch briefly on our permanent incapacity payments as well. But when we're talking about our death benefits, which is primarily the reason a lot of people hold insurance inside a super, is that we know that the tax-free component is always going to be tax-free, right? We then have our taxable component, and it's going to be tax-free to a tax dependent, and it's going to be taxable to any non-tax dependent, but subject to having or holding insurance inside super and subject to the member passing away prior to or pre-age 65, then we may have to calculate an untaxed element. So there's a few triggers there. If we hold insurance and if the fund has ever claimed a deduction or intends on claiming a deduction, and the insurance proceeds are paid out to a non-tax dependent, then we have to calculate an untaxed element. So our taxable component is broken down into taxed and untaxed. But it's very specific set of circumstances there. Now, one of the issues that needs to be highlighted is if you have a insurance policy and you have claimed the insurance premiums, and then you think, like, and you misread or misrepresent the untaxed element bit and says, okay, well, I haven't claimed a tax deduction this year or last year, that's irrelevant. If you've ever claimed it, right, and the insurance policy still exists in the fund and the benefit is paid out, then you are going to have to claim the untaxed element. So you either never claim a premium and therefore you don't have to calculate an untaxed element, or just assume that if there is insurance, the benefits paid to a non-tax dependent and the death occurs pre-age 65, that you will have to calculate an untaxed element, and that untaxed element will be taxed at 32%. So that's 30% plus the Medicare levy. So let's have a look at that untaxed element calculation. So we've got the SMSF's got a life policy for Michael of $1 million, and he's been paying his premiums each year. And the fund was established in November 2014. Michael's service period started on the 1st of February 1996. Now, why is that important? Well, it's important because these calculations are all based on service period. So for those that have been in and around super long enough, we know that service period is one of those sort of weird concoctions that certainly meant a lot more to us when people had pre and post 83 components as part of their lump sums before 2007. But for a lot of these calculations around insurance benefits and disability benefits, then those service periods are still very relevant. Now, in Michael's instance, for example, if he had have set up his self-managed super fund in 2014 and not rolled over any money from an existing fund to the super fund, then the service period, the start date, would be his membership period for the fund. But if you roll money in, then you're going to adopt the earliest service period. So that's often, a critical consideration with regards to people that maybe have super elsewhere and are looking at self-managed super funds, what the impact of the eligible service period might have on some of these calculations. Now, again, it shouldn't be the overriding factor because, most people's objective would clearly be that they don't want to pass away pre-age 65. And a lot of the deductions are irrelevant and a lot of the calculations are irrelevant once we get past 65. So just sort of highlighting the key difference between service period there. Michael passed away in October 2023, right? And he had life insurance, which will then credited to the fund. So there's be a death benefit of 1.3 million, which was the insurance proceeds plus $300,000, which is sitting in the fund, paid to a non-dependent in November 23. And there's $100,000 worth of a tax-free amount. So what we have to do is we have this calculation there, which is sitting on the right-hand side. You've got your element taxed in the fund. So you actually have to work out what the element tax of the fund is. And then from that, you effectively, from the benefit payment, you subtract that to get the untaxed amount, which is taxed at the higher rate. So what do we need? We need date of births. We need to know at what age somebody will be turning 65, because that's the critical day in the days to retirement. We need to know the service period. So when did they start? We need to know the date of death. So when did they cease employment effectively? Or when, in this instance, when did they pass away there? So we've got our service days, we've got our days to retirement, and we've got our total service period. So the first thing we do is we take our benefit, we multiply it by our service days, then divide it by service days, and then our days to retirement, right? So we've got 1.3 million multiplied by 10,000 divided by 17,000 gives us $760 odd thousand, or take away our tax-free amount of 100,000 means we've got 662 of taxed element inside our taxable component. We then work out our untaxed element, right? And that is 1.2 million, which is our taxed component in its entirety. So we've got our tax component, which is 1.2, our tax-free, which is 100,000. We then take away the taxable element of 662, means we've got 537,000 at 32%. So we can see that when we've got insurance in the fund and a death benefit likely to be payable to a non-tax dependent, then there is going to be a higher tax outcome to contemplate. So therefore, the question mark around, okay, should the money or should insurance be held inside or outside of super if somebody only has non-tax dependents, is certainly one of the key considerations that people need to be mindful of. Of course, the other sort of calculation that we do often in this place is the disability superannuation calculation. And whilst I'm not really going to spend any time talking about that today, what we have to understand there is that we get the additional tax-free portion. So if somebody is permanently incapacitated pre-65, then we actually get to adjust our tax-free component for our service period from the date of ceasing gainful employment up until our standard retirement date. So that's how the untaxed element there is calculated. What we also want to know, and again, this is all sort of flowing into the information that I'm going to roll through with reference to the transfer balance cap and other key issues, is how insurance is treated if premiums are paid from an income stream. So, how the insurance is treated, and then what the transfer balance cap ramifications are of that as well. So what we have to work out and what we have to understand there is that insurance is ultimately linked to the interest that is paying the premium. And realistically, from an SMSF trustee point of view, you're normally going to apply or have a position in place where the standard set of rules is going to say, well, you're going to be paying your insurance premiums from your accumulation interest, because accumulation interest pays tax. I shouldn't use the word rules. I should sort of say that the standard guidance is that insurance will be paid from accumulation, because you then get the tax deduction on the premium to reduce the tax payable on the accumulation interest itself. Now, the reality is that when people move into pension, as I highlighted earlier, they're not automatically going to cancel their insurance. So then what sort of pension do they hold is going to be a key thing. Do they have a reversionary or a non-reversionary? And do they have also an additional accumulation interest? So have they started a pension because they're at TRIS stage, or have they started a pension up to the transfer balance cap and then they have an accumulation interest? So it's at that point that they're going to need to make a decision as to which interest the insurance premium should be payable from. So basically, what we need to then factor in is, okay, well, if we're going to make a decision about which interest is this payable from, what is the outcome of doing it in one place or the other? So there's been a little bit of history, a bit of back and forth with the tax office over the last sort of 10 to 15 years in regards to this place. And one of in this space, sorry, one of the key issues is that from an income point of view and from an expense point of view, right, the regulations, the SIS regulations, require income allocations to be made on a fair and reasonable basis. Now, when we're looking at it, if we see that there's a reasonable basis to pay the premiums from one particular interest, then it's fair and reasonable to allocate the earnings to that interest. And that's ultimately the position that the ATO have come back and confirmed, is that because an insurance policy is effectively a return on an investment, then if that investment is segregated to a member interest, then all of the earnings should be attributable to that particular interest as it sort of holds. And then we get into the legislative piece of it, because what we know is that when we're in pension, for example, so what we know is in accumulation, all earnings are firstly preserved, but secondly, they all are attributable to the taxable component. What we also know is that in a standard set of circumstances, once we start an income stream, then all of the earnings of that income stream are then distributed based on the commencement proportions between tax-free and taxable. So if we're having a benefit payment, then that benefit payment is split tax-free, taxable based on the commencement proportions. So what the tax officer's position has been, and this regulation came in, I think back around that to sort of 2016 timeframe as well. But what the tax office, through all this conversation, because the insurance conversation with the tax office was like a 6-7 year conversation between the industry and the ATO about deductibility and a number of issues. And this was probably the final piece. And that is that if you hold insurance inside a pension interest and that pension is reversionary, so it's auto reversionary, then the insurance proceeds take on the conditions as per the commencement of the pension. So if you've got a 100% tax-free pension that holds an insurance policy in it, then when that insurance money hits the fund, then it will be considered 100% tax-free. We've then got this set of regulations that came in, so Regulation 307.125, that provides this alternate method for determining the components of a super interest. And so when I sort of read this out, it's important to sort of see the nuances there. It applies if an income stream was being paid immediately before the member's death. So we've got that trigger point that we've got an income stream in place, and the pension did not automatically revert, right? And then no other amounts are added other than fund earnings and anti-detriment increases. And of course, the anti-detriment disappeared in 2017. Then and then one or both of the following occur. So either you pay a lump sum super death benefit or you pay a new income stream. Then in this instance, you have to apply this very specific sort of method statement for calculating the tax-free and taxable component, which is different to a standard auto reversionary. So you have to reduce the interest. So normally you would do your lump sum payment or whatever, and you would just proportion it based on the commencement percentages, but you would reduce the amount in this instance by any insurance amount that has been received, and then calculate the tax-free component in proportion to when the pension commenced. So you're excluding the insurance part and then calculating your tax-free taxable, and then the taxable component is the amount less the tax-free. So ultimately, if you have a non-reversionary pension, then the insurance proceeds are treated exactly the same way as they would be in an accumulation interest. So to give you to run through a couple of examples of that and what it actually looks like. So we've got Michael, and he died and had his transition to retirement income stream, and it's got $600,000. No nominated reversionary beneficiary. His TRIS was started with 100% tax-free. Okay, slightly unrealistic, but these days, because of the non-concessional rules, maybe it's not so unrealistic for somebody to have close to 100% of tax-free component. But he also had a $300,000 accumulation account, right, at the time of his death, and a $1 million insurance policy. And the insurance has been paid from the transition to retirement income stream. All right. And again, the TRIS at this point in time for a 60-year-old is going to be a TRIS in accumulation. So it's going to be taxable. So it may make sense to hold insurance inside a TRIS as opposed to inside the accumulation interest. When we go to pay the death benefit out, then we have our tax-free component of $600,000. So we've taken the value of the death benefit, which would be $1.6 million. We subtract to the insurance, gives us $600,000, means that's our tax-free amount based on the proportions of the pension. And our remaining balance is $1 million of taxable component. Then our accumulation is all taxable component. What does this look like if it's reversionary? Well, if it's reversionary, then it's basically the opposite effect of what it looks like in a non-reversionary environment. And so in the reversionary sense, to have that insurance sitting inside that transition to retirement income stream, then we don't have to do this calculation, this modification as per the regulations. We just apply the commencing tax-free and taxable percentages to the entirety of the benefit payment. So we have $1.6 million, 100% tax-free, right? Our accumulation interest is still going to be that $300,000. So that's pretty significant for a number of issues. And again, particularly if we're talking about somebody who is in a transition to retirement stream from age 60 from 1 July, where it's all non-assessable, non-exempt income. It's that, well, there could actually be, from a taxed versus tax-free component, it could actually be beneficial to hold that insurance inside of the TRIS as opposed to inside the accumulation interest. And of course, there's transfer balance cap flow-ons and that come from that as well, that I'll discuss or start to discuss shortly. But it is certainly an area, because let's say that benefit is paid on to his spouse, and then is received as a tax-free pension to the spouse, and then the spouse subsequently passes away and the benefits are then paid to a non-tax dependent. Well, that's all going to be 100% tax-free. And this is one of the things that I talk about quite regularly. And when we look at our next webinar that I'll be doing in July, that will be on death benefits. I'll do a bit of an estate planning session. And so one of the key messages that I always sort of talk about when it comes to estate planning is ensuring that we're not just factoring in and not just focusing on the first death benefit in a multi-member fund, but we're ultimately looking at the second and subsequent death benefits, and generally second, given that if the higher proportion of funds are spouse-based funds, it's what transaction do we need to consider when that, well, firstly, when that first member passes away, do we pay the benefit out? And secondly, if we retained it in the fund, what is the tax consequences going to be for the payment of that second death benefit? So just to sort of round out what all this sort of means from an interest point of view. So we do have to be fair and equitable, as I said before, in both the proceeds and the costs. And so if we deduct the premiums from one account, then it would be fair and reasonable. So just summarizing that point that I made before, if we deduct the premiums from one account, it would be fair and reasonable to credit the proceeds to that account, and the tax office have effectively provided that confirmation when the conversation started, as I said, 15 years ago, so 2009. And some of these things do take a little piece or a little bit of time to deal with a little bit of time in getting to a position with the regulator with regards to how these sorts of things work, and then allowing that process to flow on to clients beyond that point in time. So what we would have here is that a scenario where, for reversionary pensions, the value of the insurance is going to be credited to any continuing pension. Now, the key, and I'm going to run through an example in a moment, which is certainly far more in depth with regards to the transfer balance cap. But what we do know and what we do appreciate is that for transfer balance cap purposes, we are reporting the value at the date of death. And this is where reversionary pensions, and many of you will know that I generally take a side of saying reversionary pensions aren't necessarily the first choice or the first decision to be made, but from an insurance point of view, they can certainly be far more beneficial than non-reversionary, because from a transfer balance cap point of view, it's the value at the date of death. Now, the value of the date of death does not incorporate the insurance proceeds, because the insurance proceeds will come into the fund later. So in this situation where we had the two clients, and Nancy was we had Michael and Nancy, I think his name was Michael, then Nancy would report the $600,000 of the TRIS as her pension. That would be reported within 28 days of commencing that pension. The credit's not going to appear in her transfer balance account until 12 months later. And ultimately, the dollar value will only ever be that $600,000 from a cap point of view, even though her account balance is going to be $1.6 million. We've then got the $300,000. So in this instance, we had the $600,000, and then we had the the $300,000. So we could actually commence a death benefit income stream with that accumulation interest and have no transfer balance cap issue whatsoever. Now, I know you could also argue and say, okay, well, you've got $1.6 million if you include the insurance, and then 300,000, and the transfer balance cap is 1.9, so you could actually put the whole lot across. Well, that's true, but let's assume that Nancy also has a balance in the fund, so having that $1 million buffer has certainly got capacity for Nancy to retain far more money in the SMSF in an exempt current pension income environment by having that insurance paid into her husband's reversionary pension versus the non-reversionary pension. Because if it goes in the non-reversionary, then we're going to have to trigger it from a transfer balance cap point of view. The money has to come in first, and then it's going to be counted in the commencement value, and it's also going to be 100% taxable, which then, as I said before, is going to have estate planning ramifications attached to it. Okay, so that's kind of a brief overview or broad overview in regards to how money is allocated in when it's received and whether it takes on tax-free or taxable components, and a slight introduction to the transfer balance cap and the impact of the transfer balance cap once the pension commences, the death benefit pension commences. But then there's a couple of other, I guess, practical things to contemplate in this space as well. And so one of the things that pre-2017, we could not roll over, or we couldn't roll over pensions from one fund to another unless the purpose of the rollover was to immediately cash the benefit in another fund, which seemed, it seemed sort of surplus to needs because you could cash it out of the self-managed superannuation fund. But what we do know is since the 1st of July 2017, once we've got our change in regulation and we had this very much tightening up of the rules around death benefits to say that once a death benefit, always a death benefit, which meant that we would have to, we couldn't roll back to accumulation. There was a concept prior to 2017 where one way to interpret the legislation was you could roll somebody's benefit outside of a 6-month death benefit period. You could roll a pension back to accumulation. The regulator basically quashed that from the 1st of July 2017. They said, we're not going to look at what you've done before then, but from now on, you can't roll back death benefits to accumulation. You've met that compulsory cashing restriction. So if you're going to commute, it's to commute and take the benefit out. But what they did was they said, we don't want to restrict you to having to keep your money in the same environment. So if a self-managed super fund's not right for you, you might wish to roll that money to an APRA fund. Well, basically, we can now move that pension, and it retains its status as a death benefit. So there is a specific death benefit rollover form that can be utilised, and ultimately that pension, that money goes into the new super fund, retaining its characteristic as a death benefit, meaning any lump sums or anything that somebody wishes to take out is going to be treated as a death benefit income stream. Now, there are pros and cons of rolling money from one to another. One of the big cons is going to be that if the insurance proceeds, well, I shouldn't actually say it's a big con, because if you roll it over with the insurance proceeds, you're obviously rolling over a higher amount that you reported from a transfer balance cap point of view. But the positive side of that is you're going to get a bigger debit, which is going to give you more transfer balance cap space. And so then when you add in that new credit, it's going to not create a problem for you. But depending on what other planning and other things that you've done, that could potentially create issues. Where it does have some benefits is one of the last things that I'm going to talk about in today's webinar is this concept of the future liability to pay a deduction, future liability to pay a benefit deduction, which is the fund deduction based on the future portion of any death or disability or terminal illness payment that is paid out of the super fund. Now, that is a really significant deduction if it can be applied to an SMSF, right? And largely they can only be applied in the SMSF environment. But if you've already got a member in the fund that is in retirement phase and receiving an income stream, then that fund is already going to get the exempt current pension income, and the future liability to pay a benefit deduction and exempt current pension income deduction don't necessarily work well together, because even though you've got exempt current pension income, it will reduce that future liability deduction by the level of ECPI. So you're better off sort of having as much accumulation money in a fund and claiming that future liability deduction versus having ECPI. So in that instance, if you've got multiple members in the fund, you may look to roll the retirement member out, or at least a retirement interest out, to another superannuation fund and maintain just the accumulation interests to maximize the tax benefit inside the fund. So look, that's really just sort of taking the strategy side of things to a different level. But needless to say, we've got this capacity to now roll over our death benefits, which means we can roll over those insurance proceeds, and we can continue to pay an income stream from another fund, be it an APRA fund or a self-managed superannuation fund. So let's move into this concept of insurance and linking it to the transfer balance cap and Div 296 considerations. So what I'm going to do now over the next few slides is I'm going to reference a bit of a case study and look and talk through things from a number point of view, and sort of identify strategically some of the considerations that you might have for clients, particularly large balance clients, in light of the theoretical introduction of Div 296. And when I say the theoretical introduction, we all expect it to go through. It's kind of halted or stalled a little bit in Parliament at the moment. We've got sitting days next week to see if there's any progress made on it, but let's assume that in some way, shape or form, Div 296 is going to come in, and it's going to come in from the 1st of July 2025. So what we want to do is we want to take a set of circumstances and try and build them out to see what the strategic and potential ramifications are with reference to reversionary versus non-reversionary versus the insurance in the fund, and what impact that has on potentially on transfer balance cap, and in addition the Div 296. So take the situation. This is taken from our Smarter SMSF case study that we use for a lot of our masterclasses in our SMSF day. We have the Little Brewers Super Fund, and Andrew is the senior member of that fund, and he is married to Mary. So I'm going to introduce you to Mary in a moment and a bit about her balances. But Andrew commenced a pension at the 1st of July for roughly $970,000, which was 28% tax-free. Okay, so it had large, significant taxable component. So he moved all of his accumulation interest into that retirement phase. He then made, in the start of the 23-24 financial year, he made a number of contributions. He made some non-concessional, he made some downsizer, and he made some CGT small business or CGT cap contributions as well. And so he started another pension on the 1st of August 2023, once all those contributions are made, for $1.13 million, which is 100% tax-free. Now, of course, when he does that, we've got 1.13 and 970 odd, puts us at 2.1 million, which puts us in excess of the transfer balance cap. But he does a commutation on the same day, a partial commutation from the first pension, right? So the partial commutation of the first pension to reduce the transfer balance cap back to nil, because transfer balance cap is the one sort of legislative anomaly where it's measured, it does have a reference to time of day, and it is measured at the end of the day. So in this situation, what we have is Andrew with an accumulation interest of about $200,000, two pensions, one of those pensions being 100% tax-free and the other pension being 28% tax-free. And we've now got, at this same point in time, our $1 million sitting insurance. So Andrew had $1 million in his fund. He was, at this point in time, only in accumulation. So a decision has to be made at that point as to where the insurance proceeds need to be, or where the insurance premiums need to be paid from following the 1st of August 2023. And this is really that point where the trustees need to sit down and look at all of the key considerations noting his balance, noting Mary's balance as to what the potential outcomes are going to be. So we now jump forward, right? So that's where Andrew started, right? And we're going to look at sort of the ramifications of reversionary and non-reversionary and the insurance and the issues associated with that as well. But we now jump forward to the 27-28 year. So first thing first, we're now in the Div 296 environment, okay? So 1 July 2025-26 is our first year. The first lot of liabilities are going to be out and about from following that 30 June 2026. So Andrew is in a Div 296 environment because his balance is sitting at $3.2 million in rough sort of numbers there. Mary, who's 63, she's got $1.67 million, right? And is not in a Div 296 situation. So there's no circumstances really that will result in Mary having a Div 296 on her balance alone, okay? But we now need to talk a little bit about Andrew. So some of the decision-making processes that we have to take, and ultimately we're taking these decisions in the 23-24 year, is how much money does Mary have? What are the consequences of making Andrew's pensions reversionary or non-reversionary? And where should we put the insurance? Now, these illustrations are really just to highlight some of the key issues that we need to consider, not to say one way is better than the other, because what you actually note is that one way is going to be better for transfer balance cap point of view, but it might not necessarily be better for future Div 296 issues and that. But it's really just going to be play it by ear and see what the circumstances are. So what we need to do is we need to always look back from a total super balance point of view, look forward to what opportunities are available to us. And what I've done is I've made an assumption that the general transfer balance cap at 30 June 2028 is going to be $2.2 million. So let's wait and see on that one and see if we can call me out and say right or wrong in 4 years' time. So what we've got is our reversionary pension for Andrew. So let's look at this now first exclusively as reversionary versus non-reversionary. So we know that that Mary's got her 1.6 million. We break Andrew's balances down to 1.19 in pension 1, 1.74 into pension 2, and then $300,000 in accumulation. We then have the event, right? So the key event that occurs is that Andrew dies in March 2028, right? So March 2028, Andrew dies, and we know that account-based pension 1 and account-based pension 2 are auto-reversionary, right? So the first thing that we understand in that situation is that there is this transfer balance cap deferral. So for 12 months, Andrew's pensions can both revert to Mary without any consideration of the transfer balance cap until immediately prior to March 2029. And so this is one of the things. So strategically, what you would potentially look at here is go, okay, well, we can leave 1.74 in, we can leave 1.19 in. We can also, in theory, add 1.67 for Mary and start a pension at that same date. She's 63, so she could use this as an opportunity to potentially retire. She could start a pension, and then subject to her own contributions and what she's done, that accumulation amount, which must be paid out, it could potentially be paid out as a death benefit income stream and added to Mary's pension. Meaning for 12 months, we're going to get exempt current pension income on the entirety of Andrew's and Mary's balance. So that's just one strategy, not contemplating too many considerations other than the only thing that would be measured against Mary's personal transfer balance cap at that point in time would be her interest and the death benefit income stream for $313,000. And if we're assuming that the general transfer balance cap's around that 2.1, 2.2 million, then there's not going to be a problem there. So that's actually not a bad consideration from a strategy point of view. So Mary has this effectively this non-concessional opportunity here. So we could even pull out Andrew's accumulation interest, right? We can pull that 313 out, and we can put that as a death benefit and put that back in as a non-concessional contribution. And again, subject to the family dynamic, making it a non-concessional contribution from a future death benefit point of view might be more beneficial than leaving it as potentially 100% taxable component. Alternatively, subject to what the taxable component is for Andrew there, you know, in Mary's circumstances, if her money is significantly taxable, then you might actually want to do a drawdown from her 1.67 and then recontribute back in to create more of a tax-free component. So there's so many opportunities that we need to contemplate in this space. But then what we look at and we go, okay, well, from a Div 296 point of view, there is no what's the word I'm looking for? There is no Div 296 for the member that passes away, right? So assuming that you don't die on the 30th of June, and Andrew hasn't died on the 30th of June, right, then he is effectively washed out of the Div 296 environment. With Mary, what actually occurs is because these are reversionary pensions, right, her balance at the start of the year is below 1.67, and her balance at the end of the year, right, and I haven't factored in, I have, you can see in that calculation, I've put the balance of the defined benefit or the death benefit income streams as 4 million, because I'm incorporating that the insurance is going to hit the fund between the 3rd of March and the 30th of June. But what we know is a death benefit pension, right, reversionary or otherwise, and insurance proceeds are both contributions in the sense of what we add in and take out of our earnings calculation for our adjusted total super balance for Div 296 purposes. So we're going to defer any Div 296 liability for Mary until the 28-29 financial year. So that is significant in that regard. And that in the first year, no issue, all the money goes across. But what it does is it's going to trigger that Mary doesn't have any capacity to make a non-concessional contribution at all in the 28-29 year. And then we're going to have to do a death benefit lump sum come the 3rd of March 2029. We're going to have to commute at least sort of the difference between Andrew's 2 pensions, right, and the general transfer balance cap, which is going to be the 2.2 million. We're going to have to commute that amount and take it out of super. And with Mary's, we can commute her income stream that started with her 1.6 million, and we can roll that back to accumulation. Now, this is where strategically you might say, okay, well, we're better off, instead of paying a death benefit income stream with Andrew's $300,000, we're better off actually paying that out, and then Mary using that to make a non-concessional to increase her balance to 1.9, because then when it comes to the 12-month anniversary, she can roll her benefit back and not have to pull out our super and only have to pull out the excess of Andrew's. Whereas if we pay 3 death benefit income streams, 2 reversionary and a new one, then we're going to have to pull that money out of super. So, you know, there are things to contemplate there. And in this instance, obviously the insurance firstly is going to be a problem in that second year with reference to the Div 296, but it's not going to be a problem. It's not going to count from a transfer balance cap point of view. So that's a significant benefit that we get out of the reversionary pension, is that from a transfer balance cap point of view, we're still going to be able to have pretty close to $3.2 million in those death benefit income streams come the following year, 30 June 2029, because $1 million of it, being the insurance proceeds from the reversionary pension, does not count towards the transfer balance cap. So as far as money being retained in the super system versus outside and entitled to the exempt current pension income, holding that insurance policy inside a reversionary pension is certainly beneficial, right? Certainly beneficial from a future ECPI position, and certainly beneficial if that pension, right? And in this case, we've got $1.13 million tax-free as a pension. So to have the insurance premiums paid from that $1.13 million pension ultimately means that those insurance proceeds will always be tax-free, which is going to be significant when it comes to paying out Mary's death benefit to the adult children that are surviving at that point in time. So that's a key thing to contemplate there. So let's look at it from a non-reversionary point of view. So again, we've got that potential, we've got that interim lump sum that we would potentially need to be paying out. Now, the other thing about that, by the way, is when we take a death benefit from, because what we know is with death benefits, without getting too caught up on it now, is from an accumulation point, you can make an interim and a final lump sum. Once you start pensions with it, then those commutations are death benefit payments, but they don't count towards the interim and final. So you've got that flexibility once you're in pension to draw down multiple lump sum interest. So now let's look at it from a non-reversionary point of view, and this sort of changes things, and this is where insurance and transfer balance cap can become a little bit more complex, because we've got the same set of circumstances that apply, except this time we've got non-reversionary pensions. So when Andrew passes away in March 2028, we've got to look to pay the death benefit out, right? What we also know is that from a transfer balance cap point of view, the day that we commence the pension is going to be our reporting date, and then that's going to be the trigger for when we have issues from a transfer balance cap point of view, but also a Div 296 point of view as well. And so March is, from a timing point of view, if somebody passed away in March, it actually creates this buffer where we can not act until the financial year, because it's pretty reasonable to say that as soon as practicable includes at least another quarter, and you can commence pension, you can take action from the 1st of July 2028, that situation. So we've got this interim lump sum that we're going to pay out. What are we going to do with the insurance? Because if the insurance is sitting in, say, either the accumulation or in a non-reversionary pension, we go back to the method statement for calculating the components, and we know that this insurance takes on the componentry of being 100% taxable, right? So it doesn't pick up the concept, or doesn't pick up the components of the pension that it resided within. So if you've got non-reversionary pensions, it's really not of any value to hold those insurance policies inside the pension interests themselves. So we've got no transfer balance cap deferral. There is the non-concessional contribution opportunity for Mary, but then potentially she also can defer that, because whilst the money is sitting in Andrew's interest after he passes away, it doesn't count against Mary's transfer balance cap, or it doesn't form part of Mary's total super balance until it's actually allocated to her. So with the reversionary pension, we don't have that second year opportunity for non-concessional contributions for Mary, because the reversionary pension goes to her from day one, and her total super balance gets triggered from day one, and therefore is going to be higher at the next year. But if we act in the new year with Mary, and we move the pensions and commence pensions from the 1st of July, then we've actually done a couple of things, because what we've also done by commencing it after this date is we've moved everything across to say that her pension commences in the new year, which means that she will get a credit value. So her 30 June total super balance is still going to be her 1.67 million, maybe 1.9 if she's made a contribution in that year. So her total super balance is going to be below the Div 296 threshold. In the following year, we've commenced a pension for her with the death benefit income stream. When we then go at the end of the year, we say, well, what is her adjusted balance? Her adjusted balance, so knowing her balance was below 3 million at the start, her total super balance is 4.4, but then with the adjusted taxable amount, we take out the pensions that we've commenced, and potentially the insurance that has hit the fund. All of that comes out, and we're unlikely to see a Div 296 assessment in that year. So non-reversionary pensions, whilst there is potentially a greater need to pay out the insurance and other things earlier, and there is not as much capacity from a transfer balance cap to get that additional 12 months ECPI, we might get a deferral on the Div 296 liability. Now, what's better? Are people going to be preferencing a Div 296 deferral or more money in from an ECPI? I'd probably argue the ECPI argument, because the Div 296 calculation may not be significant for them, but ultimately it does give us far more strategic opportunities to consider. And it starts with, where is that insurance going to be held? So I've got a question there. So for a non-reversionary pension, what happens if the death benefit paid out longer than 12 months due to some factors that are out of the trustees' control? Will non-reversionary pension be a better option? So look, I can't say yes or no, it will be a better option. But what I will say to that comment there about the 12 months is, what the 12 months does, if it's outside the trustee's control, is it means that it retains. And so the answer could potentially be yes, because it means that you retain the exempt current pension income, right? So the money is still sitting in Andrew's account. So it means there's a longer period that it's not in Mary's account. You're going through all of the requirements to pay the benefit, but it just is taking longer to do it. So it could actually benefit you from a maybe from a Div 296 point of view, and definitely from a transfer balance cap point of view, by having that longer period. What it doesn't help you with is that the insurance proceeds, so if you don't pay that benefit out, those insurance proceeds are not entitled to the exempt current pension income deduction. Okay, so it's similar to that method calculation before. The ECPI is only applicable on the pension immediately prior to their death, plus earnings, excluding insurance. So that's just one thing to factor into that conversation. So look, a lot to take out of that with regards to the strategies and how they all sort of play out. So what I want to finish with, just for the last couple of minutes, is just take you through this deduction for future liability to pay benefit. And again, this is a deduction where instead of, so insurance gives us capacity to claim on the premiums, or it gives us the capacity to claim on the future liability to pay benefit up until age 65. Now, we've got a cake and eat it too scenario, in that we can claim on the premiums to start with, and then we can elect not to claim under the premium and claim on the future payment. So if we look at Michael's situation, again, we've got our $1 million, all of our other circumstances are the same. So we've got the date of death the same, the total payout $1.3 million. But the fund makes an election under 295465 not to claim a premium, but rather to claim a deduction under the future liability to pay a benefit. And that calculation looks like this, which is the benefit amount, the entire benefit amount, multiplied by our future service days, divided by our total service days. So we've got $1.3 million multiplied by future days of 7,000, divided by 17,000, gives us 537,000. So this fund would claim a $537,000 tax deduction in year one, ultimately creating a tax loss, and that tax loss can offset the tax liabilities of future years. So it's pretty significant. And again, that's why I'm saying that once you create that tax loss, you're better off sort of moving any retirement income streams to another fund, so that you're not sort of diluting that loss in any given year. So the legislation, the way that it's written, basically provides, and there's some ATO references there, ATO ID 2015 sort of 17, that you don't have to make the election at any time until just prior to the lodgement of the return. So you've got to make sure that you can make the election in a year that you paid a premium, right? So you could make an election one year and then the death benefit is paid out the following year, but you've got to elect not to claim the premium first, is one of the critical things. The other thing is that it's got to be in consequence of the termination of employment. Now, this is sort of where you have to look through the consequence and say, was that person not working prior to the event that led to their death or their incapacity or the terminal illness? If they weren't working, then you can forget this future liability deduction. If they were working and their condition resulted in them ceasing employment, then the tax office don't dig too deep in that regard, right? But they do provide that opportunity for people to claim there. It is critical, obviously, that you are under 65 at the point of death, disablement, terminal illness. So again, what I reiterate with this deduction is it's significant because it applies across death, disability, terminal illness. It's not just a death benefit deduction. So any insurance payout pre-65 could potentially enable a fund to claim this. But you want to make sure that you've done all your checks and balances beforehand to see that you are eligible for it. So let's summarize it. So since the 1st of July 2014, we have to have our insurance aligned to our conditions of release. We have to make sure that we understand what our deed says around insurance, what our deed does potentially provide for there. And then we need to strategically look at things from a transfer balance cap point of view, which means where we allocate the premiums from on an ongoing basis, what implications will that have on a transfer balance cap, but also on a potential Div 296 position for superannuation funds moving forward. And what I would say there is, just like asset segregation, this is not something that you should be looking at changing every year based on circumstances. It's one of those scenarios where you try to identify prior to the pensions commencing whether or not the insurance premiums should be paid out of one interest or another, particularly if you've got multiple interests there. And then the future service deduction, for me, it's one that should always continue to be talked about in regards to having it in your back pocket, so that you know that if somebody does pass away, there are circumstances where the deduction is available and potentially hugely beneficial to the fund. And of course, if your members all live after 65, then you don't have to worry about it. The fund's going to be claiming on the premiums up until that point in time. So look, that's it. Thank you very much for attending today's. As always, SuperGuardian will send out your CPD certificates, and you'll also be able to access a copy of the recording if you choose. From an upcoming event point of view, as I said, the next webinar in end of July will be on estate planning considerations. Then the 20th of August, there's been some really interesting cases recently, so I wanted to look at some related party transactions and what that means from a compliance point of view. So we'll look at that in August. We have our own pension masterclass, Smarter SMSF, at the end of August, if you want to have a look at what that might be about. And then I'm just working out what topic I talk to you about on the 17th of September. So thanks again for attending, and I look forward to catching up with you all at the end of July. So bye for now.